Well, joining me now is Ian Gordon, banking analyst at Investec, and Chris Roebuck, visiting professor of transformational leadership at the Cass Business School. Nice to see you both. Thanks for coming in. Ian, what do you think of Hester's points of view there? I put it to him that they've had 4 consecutive years of losses. Losses last year were double those of the previous year. The share price is half what it was 2 years ago, and he's talking about progress.
Well, I think he's got a point in one respect. In terms of the balance sheet, things have become a lot safer. The core tier 1 ratio of 10.6 is adequate and will strengthen as the balance sheet continues to shrink. The loans to deposit ratio has fallen from about 150% pre-crisis to 108% today. That means RBS is far less reliant on wholesale funding. However, the problem, as Stephen acknowledges, is earnings. This year's earnings, core profits fell by 18%, largely reflecting lower earnings in global banking and markets, as well as higher losses in Ulster. And then there was still over 4 billion of losses in the run-off portfolio. And the problem is, looking forward to 2012, things don't actually get a lot better. I mean, on my numbers, I think core profits will grow slightly to 6.5 billion. You'll still have non-core losses of just over 3 billion on a central scenario, but the bad news is there's going to be around 4 billion of one-off charges and losses in 2012, so we'll be sitting here in 12 months' time talking about a further loss of a similar magnitude.
Chris, what about the other issue that Hester raised with me, and that was, he said, look, it's not just about me managing the bottom line, managing the business for profit, I've got to do all that, but also I have got to change the culture of this bank. Do you understand that? Is he right? Can it be done?
Yes, he has to change the culture, because the culture that was set up under Fred Goodwin took one more aggressive approach, and I think what needs to happen now, not just in RBS but in all banks, is that change needs to come within the culture, so the banks take a more reasonable approach to the way they do business, a more sensible approach to risk, a more sensible approach to bonuses. And to a degree, Stephen Hester is leading the charge, because he had perhaps the bank that was in the worst possible situation. And he's having to try and accelerate it to get it into the best possible situation as fast as he can.
Now, in your investment note today to Investec clients, you put a target price on RBS's share price of 30 pence. Well, if they make that target of 30 pence, it's still a long way from 50 pence, which is the break-even point for the taxpayers. Are we going to be old and grey? I mean, I already am old and grey, even older and even greyer, before we see any return.
I mean, I think the reality is there's an awful long way to go. My 30p target price is where I aspire to get to in 12 months' time.
Right.
As I said earlier, I still think RBS will be reporting losses in 12 months' time. And even if you look at market consensus expectations, they forecast a return on equity of 2% this year, 5% in 2013. To see RBS covering its cost of capital, you probably need to look out to about 2016, and when that happens, maybe the market will put it on a 1x book value, which, guess what, is 50.1p, almost exactly the government's entry price.
Where they need to be. But of course, if it gets to 50p, the government can't sell at that, because if they dump 82% of the company on the market, the share price will shrivel.
Precisely. And it's ironic, if you look back to how did we get here? We got here because the third tranche of the government stake was invested, at Alistair Darling's say-so, at a 71% premium to the then prevailing share price in December 2009. Quite why, I do not know.
Painful. Now, what about the political dimension of this, Chris? Hester himself has had huge pressure applied from Westminster. The charge has been led by the Labour Party, but yesterday on this show we heard Alistair Darling saying that when he was at the Treasury, or certainly when he was in government back in 2006, 2007, the Treasury was cheering bonuses. They loved it because, of course, the tax funds were flowing in. Isn't it a bit rum now that they've turned on these banks?
Well, if you look at the history of the way the banking markets went before the crisis, the Labour Party in government was leading the charge. The tax revenues were flowing in, and nobody was saying, actually, you need to take less risk. Regulators were very, very relaxed, and to a degree, that's why we got where we got. It wasn't actually the Tory party that were in power when the whole thing blew up. and that can be levelled at certain governments around the world who were perfectly happy to take things when times were good and take the credit, but when things went wrong they started pointing fingers at the banks. And let's be honest, it wasn't just the banks that created the situation that caused the implosion.
Indeed, and of course if we wiped out all bank bonuses there would be a hole in the tax revenue.
Perfectly true. Though the funny thing is, we're sat here talking about bank bonuses. If you actually look at the cost base of global banking and markets over the last 12 quarters, it's only oscillated between 1 and 1.3 billion throughout all that period, whilst the business in question has swung from a profit of 2.8 billion to the loss reported in the last quarter today.
Interesting. Isn't the point here, the truth here, that RBS is in the investment banking business? In good times, that's where the huge profits are made. That will always be a bonus industry, and if we want RBS to be in investment banking, we just have to accept it.
To a degree. I mean, again, first quarter of 2009, the investment bank created 80% of core profits in the bank. This quarter, they reported a loss, and that's because RBS is perhaps, to be a little bit harsh, maybe 6 months behind the curve in terms of downsizing those areas which no longer make economic sense, partly because of macro factors and partly because the fixed cost base became too high.
Briefly, Chris, putting on your professor's hat, how many marks out of 10 does Hester get for work done so far?
I think, bearing in mind what he actually inherited and bearing in mind where he is now, he's probably doing reasonably well, 7 or 8, and his emphasis on performance and pay is absolutely critical, because if that can be achieved, then it's better than some of his competitors.
7 or 8 sounds like an A pass. Nice to see you both. Many thanks for coming in. We appreciate your time.
Thank you.